Good morning, everybody. It's great to see so many people here. I hope that you'll find the event exciting and inspirational. It's definitely one of the highlights of the year for the RavenPack team, and especially for the data science team as well, given that it is a research symposium. For those of you who don't already know RavenPack at this stage, what we do basically is that we're a big data analytics company focusing on the financial industry. And more specifically, we make unstructured content text actionable for financial professionals. And the way that we do that is by adding structure to it. We focus on entity detection. We cover anything from companies, people, products, places, organizations, currencies, and commodities. So you can say that we are, one of the few data sets that are truly multi-asset class when it comes to alternative data sets. We also do event extraction or event detection. We cover nearly 6,900 different types of granular events today. They fall into 5 broader topics. So we cover anything from business-related news, to economic news or events, to societal, political, and environmental events as well. And that could be anything from earnings guidance around interest rates, guidance around other traditional economic indicators. It could be about product recalls, layoffs, CEOs getting fired, killed, or kidnapped. Some of these are, of course, more frequent than others from an event perspective. We also cover anything from elections to civil unrest, war conflicts, and very timely also in terms, we also capture hurricanes and other natural disasters. We also, as a second dimension, we look into relevance scoring, not only at the entity level, but also at the event level. So we will tell you how relevant are particular entities within a document. Are there only one entity detected, or do we have multiple detections? Are they mentioned in a headline or deeper in the story body? How often are they mentioned, and so on? And that will give you a way of alleviating noise. Several studies have shown the importance of relevance when you do signal construction. More recently, we have also introduced the concept of event relevance that works in a similar fashion. So of course we detect events throughout the entire document, but we will also let you know exactly where the event was initiated. Whether it was initiated in the headline, whether it was initiated deeper in the story body. And we have also found through our own research that this also matters when it comes to predictions, price predictions. Especially in one of our research papers, we show that if you want to trade large cap US stocks, generally, they are mostly headline driven. However, as you go to smaller names, you start to extract more value out of going deep into story body for event detection. And I think that makes a lot of sense in that smaller names have a harder time reaching the headline. So definitely looking into event relevances is of importance. We also do novelty scoring. So is it the first time that you have seen a particular event within a certain time period? It could be 24 hours, but you could set, in essence, your own window for what you define as being novel. But you could also look at it from a way of saying, is there a lot of buzz supporting a particular event? And actually, we have just recently, or we will share with you, following the event, links to our 2 most recent papers. And one of the papers, the one that I'm not covering today as part of the presentation, focuses on the concept of event buzz, showing that if you have abnormal news volume on a particular company, you'll see that those company, the prices will react more strongly as opposed to having only very little news to support a particular sentiment. We get something like two times greater reaction if you have event buzz versus high event buzz versus low event buzz. And finally, we also do sentiment scoring. Sentiment scoring will give you a sense of direction and potential strength of a particular event. And combining that with our event detection capabilities is pretty powerful. It will give you another dimension with that combination, also understanding potentially how quickly is information incorporated into price. Sentiment, of course, is only directional or strength, but it doesn't give you that last dimension of the speed of decay, potentially. The other aspect of it is also that you can relate the sentiment to something, look at whether it is more forward-looking, predictive, or more explanatory in nature. And therefore, it's also a very powerful filtering option to look into that combination. Over the years, there's been quite a bit of research done on the RavenPack dataset, both internally in our own data science team, but also by third party. And I would say initially most of the research was done within the equity space. That's kind of also where alternative data sets started out, partly because it was easier to relate, events to companies, because companies are mentioned in the news themselves, where macro is a little bit, you need to infer the instruments that you wish to trade, because the instrument itself might not be mentioned in the news or within a particular document. But if we started looking at some of the equities research that was done, we have multiple examples of use cases. Deutsche Bank looked at more traditional pairs trading strategies and tried to come up with a filter saying, when can we try to reduce our non-convergence risk, saying if there are times where you see divergence in prices, perhaps it's really just a regime shift in how those two companies behave or move together, and therefore we can't expect them to converge. And they found that using abnormal news volume as a filter on top and combining that with negative sentiment, they were able to significantly reduce convergence risk. We have also seen research that looked at more traditional factor models like momentum, value, quality indicators, and also trying to incorporate sentiment as either a standalone factor or as a filter on top of traditional factor to help you prevent you moving to a value trap or figuring out when momentum is running out, and so on. This type of research has been covered by Wolf Research, by Macquarie, and also by FactSet as examples. We have also seen studies done intraday by Inset Wharton is an example. They looked at sentiment as a directional predictor of intraday price movements, and they showed in particular the importance of filtering for relevance to alleviate some of the noise coming from this type of data. And finally, on the equity side, as listed here on this slide, we also saw Nomura building strategies, short strategies, doing stock selection amongst companies that had negative sentiment and did that with success. More recently, we have seen a bigger focus, a bigger shift generally in the marketplace, but also in the research that has been done. It has started to become a little bit more macro-focused. A lot of the macro funds and global macro asset management companies are looking more towards alternative data than they were early days. And we have seen a lot of papers, or quite a few papers coming out covering this space. We saw, of course, the big JP Morgan report, where that also contained some studies on RavenPack data. They looked into building strategies around equity indices, forex, and sovereign debt. We have seen papers done by Duke University looking at building supply-side, demand-side sentiment indices across the dimensions of economic and environmental news, showing how that could be used to predict oil prices. Trend Pointers looked at market timing of equity indices as well. The Thalesian and Saeed Amin looked into FX carry strategies, enhancing them with sentiment, and looking also at sovereign debt. So there's been quite a bit of research done in the macro space. It sounds a little bit like Superman is arriving or something. I think it's the theme song from Norris. So we're kind of continuing down that same path of macro trading and trying to take our view on it. And in particular, we are focusing on commodities trading. And we take the angle of trying to create two different baskets. We create an energy basket consisting of 5 energy commodities, and we do a metals basket consisting of 9 metals. As you can see here, some of them are precious metals and some of them are industrial metals, and potentially you could have split it into to do 2 different baskets, but we didn't try to do that as part of our research. We work at the basket level for 2 primary reasons. One is on the estimation side and one is more on the trading side. So from the trading side perspective, of course, we try to trade a bigger basket because we get some diversification, some signal diversification, which will obviously impact our overall information ratio or Sharpe ratio of the strategy that we end up creating. And the other side is also because not all of the commodities are equally liquid in the news. So we try to model, they may have similar, or in most cases they will have similar events associated with them, some related to new discoveries of the particular commodity, or news about inventory changes and so on. So they share the common events, and therefore we decided to try and train our models across the basket. But let's try to look first at the research outline. Well, we split, of course, our data set into an in-sample and an out-of-sample period. We used 10 years for in-sample, 2005 through 2014. We keep separate the out-of-sample period from 15 through August 2017. As our dependent variable, we look at volatility adjusted 1 day ahead log return, so we try to make 1-day predictions. And we volatility adjust in order not to emphasize the higher volatility commodities too much in our modeling process. As independent variables, we use the RavenPack event taxonomy, and specifically we focus at the most granular level, where we have, as I mentioned before, almost 6,900 different categories. Of course, not all of them are associated to commodities, but we work at that very most granular level, and we also consider our event relevance score. So basically saying, where did we pick up the event? Was it a headline-driven event, or was it detected deeper in the story body? And finally, we apply a range of machine learning techniques on these variables. We look at 10 in particular, anything from both supervised and unsupervised methods, like principal component regression or partial least squares. We do some elastic net to capture some linear models. We do random forest, SVMs, neural nets, and so on. The idea is not so much to pick a particular model which is the best one. We actually end up doing an ensemble on the different models. But the idea was just to try a few techniques and see whether we could get something that was pretty robust across the various models. But the first thing we want to do is of course create an indicator. How do we look at this event data and try to build our input matrix? So as I mentioned, we looked at the events detected by RavenPack, and then we apply some basic filters. We say that it has to be novel news. We define novel in this case as being on a 24-hour horizon. So the first time that a particular event for a given commodity was mentioned, we will pick it up. We also only look at commodities news, so the commodity itself has to have been mentioned as part of the event. And that reduces the potential event categories that we take into consideration to about 100. And then, of course, the news has to relate to one of the 14 commodities that we look at as part of our research. The table that you see here displays or shows some counts and some percentages, and I think the most relevant I wanted to highlight here is just saying, there are certain commodities like copper, crude oil, gasoline, gold, and natural gas that are some of the more frequently appearing commodities with events, and you have an event on average of about every 2 days. The least used liquid commodity is rebar, which has an event more or less one time a week. So in order to construct the indicator itself, we take advantage of the event relevance score. We take a simple average of the score, and that's basically our indicator value. If there's an event, we use that average score. If there isn't an event, we simply give it a 0. And as I already mentioned, that really allows us to tune in or overweight or emphasize more events that we would consider having higher irrelevance than lower event relevance. These are the general results of fitting the different machine learning models that we try to apply. And you can see all of them do fairly well. There are some nuanced differences amongst the various techniques. Generally, we find principal component regression not to work particularly well, but the supervised version of PLS does somewhat better. If you look at it and just say, these by the way, are the auto-sample results. The ensemble results look very similar. But you'll see, for instance, for our energies basket, we find the KNN model to be the best performer with an information ratio of 146. By the way, there's no transaction cost involved, and just to reiterate that it's based on 1-day predictions here. On the other hand, on the energy basket, the metals basket, we tend to find some good performance with some of the gradient boosted trees regression models, where we are able to reach an information ratio of 3.36. As you can see here, even though all of the models do pretty well, there is some variation, and therefore there may be some opportunities to get some additional improvement on looking at it from an ensemble approach and not having to make it necessarily a particular model selection. And if we do that, just taking a simple equal weight across the 10 predictions coming out of the 10, across the predictions coming out of the 10 machine learning algorithms, we're able to achieve lower average prediction error. Generally, which is quite nice to see, and again, not necessarily particularly surprising. And as you can see, both the energy strategy that we create and the metal strategy does pretty well. We prediction weight our strategies on a daily basis, and we end up holding on average for about 2 days. But in terms of information ratio, the ensemble gives us around 1.3, and on energy, and 3.1 on metals. So we perform slightly worse than the best selection from the previous slide. But that, of course, also required that we actually ended up picking the best model in the first place from our ensemble selection, or ensemble period. If we look at per trade returns, we get about 6 basis points on energy and 9 for metals, and that translates into annualized returns of about 18% for energy and 36% for metals. If we look at it from a marginal contribution perspective, we try just to say, okay, does our result rely on any particular commodity? So we try to just take out, one at a time to see how that would have impacted our performance. For energy, we definitely found crude oil to be the most, the one that contributed the most. And as a standalone strategy, it was able to get an information ratio of about 1. But even when we removed oil from the equation, we still got information ratios close to 1, just shy of 1, where most of the other commodities didn't really have massive impacts. When it comes to metals, for sure, our copper, if we just looked at copper on its own, it had quite a good performance as a standalone strategy. And dropping copper from the metals basket had somewhat of a bigger impact, and information ratio would drop quite significantly, but still staying close to 2. Other important commodities in the metals basket seems to be rebar and zinc. Otherwise, the other ones had less of an impact. One of the other things that we tried to figure out was if there were certain time periods where our signals were particularly strong. Were there certain regimes that we could tune in on to see whether, where we were making our profits? And one of the natural ways of looking at regimes is, of course, to look at volatility regime shifts. We wanted regime shifts that were occurring relatively frequently. So instead of looking at volatility levels, we looked at whether volatility was generally increasing or decreasing. And somewhat by coincidence, it kind of split up our data set into two equal parts. And we end up, creating a strategy for increasing volatility periods and one for decreasing volatility periods. And we determined those regimes by looking at or contrasting the 10-day volatility against the 21-day volatility per commodity. And as you can see, by doing that, it was pretty clear from energy that most of the profit was made when volatility was increasing. We have, if you look at per trade returns, about twice the return in increasing periods than we did in decreasing periods. We saw something similar for metals, 11 basis points per trade in increasing periods and only 7 for decreasing periods. Even though we kind of have the number of trading signals or trades that we were making, overall we were still making higher annualized returns trading this filtered basket. But we did suffer on the information ratio because, of course, you get less diversification. One of the things that we wanted to check was, yes, we did get less diversification, but is there any statistical significance in splitting up our into both increasing or decreasing periods? So to kind of take or adjust for these different sizes in the portfolios and the signals we trade, we used what we call the random portfolio. We created a random portfolio benchmark. So we took a random portfolio approach where we basically said, okay, if I have 9 commodities in my basket and I have 9 trades today, but my volatility filtered strategy only traded on 3 signals, let me pick 3 out of the 9 randomly and do that, make that decision every day and do that 1,000 times over. So you kind of end up with 1,000 potential paths that you could have taken with that strategy with a random selection. And then we were able to plot, the empirical distribution of the information ratios, for instance, on making these type of random portfolios with similar kind of diversification. And if we look at it and compare our volatility, the filtered portfolios that we created based on increasing and decreasing volatilities, we were far out in the tail as compared to just the random selection of the same number of instruments. So it looks quite promising from that perspective that there is value or there is information in trying to condition on the volatility regime we're in, even though we were suffering a little bit from less diversification. So just to summarize, what are our conclusions from this research studies before I open up for questions? We found value in using the RavenPack event detection capabilities for trading commodities, and we were able to create profitable trading signals, both across energy and metal futures baskets. The various machine learning techniques that we used seem to perform pretty well, but there also seemed to be an advantage or some advantage in using an ensemble approach and trying thereby to reduce complexity and removing any model selection issues. And finally, it also seems that you can benefit from looking at various volatility regimes when you build your models, as we found stronger signals when volatility was increasing as compared to when volatility was decreasing. Thank you.
We have time for just a couple questions. One over here. Hi, thanks. It was very interesting. One question: how robust is the signal to lagging it a little further? Say, lag it to 1 day. How dependent is it to get turned over that quickly?
I think this particular signal, because it's actually fairly simple, has a fairly quick decay. As I mentioned, on average we end up holding for a couple of days, but I would say you're probably looking at something like up to 3 or 4 days in this case. Then, and you definitely want to capture the first day. We basically cut our sentiment indicator at around the close price and assumed trading on the close.
And did you do any robustness if you say had a sentiment reading an hour before to have a little bit of a gap?
We haven't done this for this particular study, but normally what we do is that we cut sentiment in our analysis on equities about half an hour before, and we have done analysis from an equity perspective, trying to push more or less. Of course, the closer you get to the close itself, the price that you trade, the better. But you can pretty safely, cut it several hours before, and of course, again, depending on signals, some signals are faster than others. But if you are looking to capture a fast signal, for sure you don't want to push it by 1 day. But of course, if you have signals or you create signals that last a month, the first day matters less.
Okay. Thank you.
Great. We've got one more question back there.
Yes, very quick question and everything. Is there any adjusting for seasonality that can be done on the commodity futures?
There's definitely a lot of other things that could be done. We try to keep our research very simple and more on the inspirational level. We didn't really look into any seasonality adjustments or anything like that. And we were actually also getting even stronger performance on the metals basket in particular if we allowed ourselves to take different approaches across the two baskets. But we wanted to keep it simple. But for sure, if you started to do something around seasonality, I'm pretty sure you will also get better performance out of it.
Great. Thank you, Peter.
This is RavenPack.